In this lecture, we are going to study the price action element called fractal bar or fractal candle depending on your preference. The fractal bar is a concept that can only be achieved by studying the different techniques under the fractal analysis and the precise relationship between the peaks of the relative strength index and the peaks of price. There is a lot more going on in price and momentum extremes than what meets the eye. Roughly speaking, the fractal bar is a way to spot a second-degree fractal reversal divergence without jumping between timeframes. We do that by analyzing the precise alignment between price peaks and the relative strength index peaks. That's the way this is done because a divergence in a lower timeframe has some effect on the relative strength index of a higher timeframe. However, this effect is very subtle, so most people simply gloss over it, and therefore miss the opportunities that come along. To be more precise, when we talk about the alignment between price and momentum peaks, we need to understand the idea of momentum offset. Most of the time, the price extremes align exactly with momentum extremes in the relative strength index. When a fractal bar appears on the chart, the momentum peak is slightly offset to the left. That basically means there is a reversal divergence happening in a lower timeframe. That's quite useful because it diminishes the need to jump between the timeframes so often while maintaining the benefits of doing it. It's a win-win situation. We call the bar in which this momentum offset happens the fractal bar. This bar doesn't need to have a specific relationship between its body and tails necessarily. It's more about the momentum offset observed. However, as we are going to see in future lectures, if a fractal bar has some attributions that agree with the context of a hypothetical trade, it's an even more powerful technique to have in the arsenal. It's relevant to point out that fractal bars spiral off from the idea of fractal reversal divergence, but they can appear within the context of a fractal hybrid divergence that has 3 degrees or more. If you studied the last lecture well enough, you will understand that this can happen because, from the second degree and below, fractal hybrid divergences are exactly the same as fractal reversal divergences. For example, we can have a fractal hybrid divergence by spotting a hidden divergence in the 4-hour timeframe and a fractal bar in the 1-hour timeframe. In this case, it would be a third-degree fractal hybrid divergence because the fractal bar represents 2 degrees, and we obviously have the first degree coming from the hidden divergence. If these ideas seem confusing to you at the moment, I suggest that you go back to the previous lectures and study them a few more times. By doing that, you will be more prepared to move on to the next lecture where we overview a series of real market examples of the fractal flow strategy techniques.